So back in 2018, the board of directors at this massive multinational conglomerate basically woke up to a complete financial nightmare.
Oh, I know exactly the case you're talking about. Just a total disaster.
Right. I mean, they realized almost overnight that nearly $500 million had just, well, it had completely vanished from their accounts.
Just gone.
Yeah, just gone. And honestly, the truly terrifying part of this whole thing, the external auditors completely missed it.
Yep.
The chief financial officer missed it. The entire, highly paid executive management team was completely clueless.
Which is mind-boggling when you think about the resources they had.
Exactly. And it wasn't uncovered by some massive government raid or a whistleblower leaking documents to the press.
No, it took one person.
Right. It took a single mid-level professional armed with basically just a spreadsheet, a really deep understanding of their enterprise resource planning systems, and this is key, a specific legal mandate to look where they weren't supposed to look. That's who finally found the leak.
And, that is the ultimate nightmare scenario for literally any corporate stakeholder. And the scary truth is it happens way more often than the general public even realizes.
Oh, I bet.
Because when a company reaches a certain massive scale, the sheer volume of daily transactions just creates this, fog of war. Management is essentially flying blind. They're relying entirely on these digital dashboards that, frankly, can be pretty easily manipulated.
Which is exactly why you, the listener, whether you're an advanced student grinding through your CA final preparations or a professional already knee-deep in the realities of corporate governance, why you really need to master this topic.
Absolutely. It's critical.
So today, our mission in this deep dive is to basically tear apart Chapter 16 of your materials. We're focusing purely on the introduction, the management functions, and the scope of internal audit.
Right. We're going to figure out exactly how to be that specific professional who finds the missing $500 million.
Exactly. We are going to explore what actually happens when a business gets so sprawling that the people in charge can no longer just rely on their own eyes.
Because, you simply cannot manage a modern multinational corporation the same way you'd manage a single-room bakery.
Right, you're not just standing over a cash register watching every $20 bill come in.
Not at all. Today, we are dealing with incredibly complex beasts. We're talking about operations that span dozens of global locations, right? They're heavily reliant on highly decentralized, really intricate technology infrastructures.
Processing what? Hundreds of thousands of microtransactions every single hour?
Easily, sometimes every minute.
Okay, so think of a modern corporation, like a massive, state-of-the-art cruise ship. You've got the board of directors standing way up there on the bridge in their pristine white uniforms, looking out at the horizon, charting the strategic course.
I love this analogy.
Right. But from that bridge, they literally cannot physically see what is happening down in the engine room. They can't see the galley. They can't see the cargo hold.
They're completely isolated from the actual machinery.
Exactly. And they certainly can't see every single crew member's daily routine or, verify if the fuel gauges are actually calibrated correctly or if someone is just siphoning off diesel.
And that specific blind spot, that's the source of deep, almost existential anxiety for the top stakeholders.
Yeah, it has to be terrifying.
It is. Think about the board of directors, or the lenders who are pouring millions in capital into the venture, or the shareholders trusting the company with their retirement savings, even the government regulators.
They're all terrified of the engine room.
Completely terrified of it, because they're making massive strategic decisions based entirely on information that's bubbling up from those lower decks.
So if that information is flawed,
or if the day-to-day affairs down in the engine room are just straight up corrupt, the entire ship is in peril. They desperately need to know that the data being reported is a reflection of reality.
they need a scout.
Exactly. They need a trusted scout.
But they can't just, pick up the phone and ask the head of the engine room, hey, is everything okay down there?
No, because the head of the engine room has a massive vested interest in saying, oh yeah, everything is fantastic. Please send my annual bonus immediately.
Right. So they need someone whose sole job is to completely bypass that normal chain of command, go down into the bowels of the ship, verify reality objectively, and report straight back to the bridge.
Precisely. And that scout, formally speaking, is the internal auditor.
Okay, so let's get into the mechanics of this, because the Institute of Chartered Accountants of India, the ICAI, they provide a really rigorous framework for this, Crate.
They do. And before we dive into how they actually do the job on the ground, we really need to understand the formal definition provided by the ICAI framework governing internal audits.
Clear.
It states, and I'm quoting here, internal audit provides independent assurance on the effectiveness of internal controls and risk management processes to enhance governance and achieve organizational objectives.
Okay, let's just stop and unpack that right there, because I know when you're studying for the CA final, it is incredibly tempting to just rote memorize a definition like that so you can spit it out on an exam paper.
Oh, absolutely. The temptation is real.
But every single word in that sentence is doing some really heavy lifting. Let's start with independent assurance. That is the absolute core of the profession, isn't it? It's not just about, like, checking the math on a balance sheet.
Not at all. It's so much bigger than that. Let's break down assurance first. You are providing a guarantee, like a highly educated, evidence-based guarantee to the board that the systems designed to keep the company safe are actually functioning as intended.
But the crucial modifier there is independent.
Yes, the assurance is utterly worthless if the person giving it is compromised in any way. If our scout is taking bribes from the engine room crew, the bridge is still flying blind.
Right, but the definition doesn't just stop at them being a corporate police officer. The framework explicitly states that the role includes an advisory or a consulting component aimed at helping the organization achieve organizational objectives.
Right.
So that implies a level of partnership with management, doesn't it? Like, you're not just a cop.
It does, and that's actually where the modern internal auditor really differs from that historical stereotype of, just a bean counter looking for minor math errors.
Yeah, the guy with the green visor in the basement.
Exactly. The modern internal auditor is there to identify gaps, yes, but they are also fully expected to recommend sophisticated solutions to enhance governance. They are a strategic asset to the company.
There's a catch. Right.
A massive caveat. They can help the organization achieve its objectives, provided, and this is a big provided, this advisory role does not compromise their independence.
And there's the friction. That is the ultimate tightrope walk of the entire profession. You have to be super helpful to management, but you cannot be controlled by them.
It's incredibly difficult to balance in practice.
Well, the text actually gives us a fantastic real-world scenario that illustrates exactly how management will subtly or sometimes overtly try to compromise that independence. Let's talk about the case of CAP.
Oh, this is a classic corporate trap. Every single CA final student needs to understand this fundamentally because you will absolutely face this in your career.
So set the scene for us.
All right, so the scenario revolves around a company called Try and Scale Limited. Now, they are a listed company, meaning their shares are traded publicly on the stock exchange, and they put out this advertisement looking for a chief internal auditor.
Okay.
So they vet our protagonist, CAP. They are highly impressed by his credentials, and they hand him a formal offer letter.
But CAP reads this offer letter and immediately sees massive glaring red flags. And the first red flag is the reporting line.
Right.
The letter states that as chief internal auditor, he will report directly to the chief financial officer, the CFO.
Which is a huge problem.
Now, let me play devil's advocate here for a second. If my primary job is looking at financial controls, accounting accuracy, and monetary risk, doesn't it make logical, operational sense to report to the head of finance? Why is CAP finding this so objectionable?
I mean, structurally, to a layman, it looks perfectly neat on an organizational chart. Finance reports to finance, right?
Yeah, exactly.
But if we evaluate this through the lens of independence, it is an absolute disaster. Think about what the internal auditor actually audits on a day-to-day basis.
Okay.
A massive portion of their scope involves auditing the finance and accounts departments themselves. They are checking the financial reporting, they're looking at corporate expense policies, capital allocation strategies, treasury functions.
And the CFO oversees all of that.
Exactly. So CAP reports to the CFO, he is essentially being asked to audit his own boss.
Wow, yeah. That's a huge conflict.
And let's look at the practical mechanics of that reporting line. If you report to the CFO is the one determining your annual salary increments, right? The CFO conducts your performance review. The CFO literally dictates your entire career trajectory within the organization. You simply cannot objectively audit the person who holds your livelihood in their hands.
Human nature just won't allow it.
Human nature and, honestly, the intense pressures of corporate hierarchy. It will inevitably force the auditor to deviate from the objective truth.
So let's play that scenario out. Let's say CAP just takes the job, reports to the CFO, and 6 months later, he finds a massive, highly embarrassing hole in the financial controls.
Right, like maybe a significant failure in how currency hedging is being accounted for.
Yeah, something that makes the CFO look incredibly incompetent to the board. Is CAP really going to write a scathing, unvarnished report to the CFO about the CFO's own failure?
The reality of corporate politics says absolutely no way that report is going to get conveniently softened.
We have some slight operational discrepancies.
Exactly. The language will be totally mitigated. Critical failures will magically become opportunities for enhancement. And the exact moment the internal auditor softens the truth to protect their boss, the bridge of the ship is flying blind again.
The whole thing becomes useless.
Right. The entire function just becomes a theatrical performance rather than a genuine control mechanism.
Wait, let me push back on this a bit, because on paper, the solution is obvious. The auditor should report to the audit committee of the board of directors, right?
Yes, that's the structural solution.
But let's live in reality for a second. The CFO still works in the building every single day. The CFO controls the overall operational budget. The audit committee, which is made up of independent directors, meets maybe, 4 times a year?
Usually, yes. Quarterly.
Even if the formal reporting line bypasses the C-suite, doesn't the CFO still hold incredible informal power over the internal auditor's daily life? I mean, they share an office building.
You've hit on one of the most difficult, messy realities of corporate governance. And this is exactly why the reporting line must be totally solid to the audit committee and only dotted to the CEO or CFO for purely administrative purposes.
Dotted meaning what? Like approving timesheets?
Yeah, approving travel expenses, allocating office space, IT equipment, that sort of thing. Yes, the informal pressure from the CFO is always going to be there, but the formal structure is what gives the auditor their armor.
How so?
Because if the CFO tries to, say, cut the audit department's budget to intentionally hamstring an ongoing investigation, the chief internal auditor has a direct protected mandate to walk into that quarterly audit committee meeting and state, "My scope is being artificially restricted by executive management."
Oh, I see.
Without that structural direct line to the board, the auditor is entirely defanged. They have no recourse. CAP rightly recognized this and demanded that the reporting line be changed immediately.
It's like having a secure, highly encrypted radio channel straight to the captain,
Yes.
completely bypassing the engine room boss.
Exactly.
But Try and Scale Limited had another, perhaps even more seductive trap waiting for CAP in that offer letter. Red flag number 2, the trap of business support.
Ah, yes.
The company also indicated that they wanted CAP to take a leading role in system automation and process re-engineering. Basically, they want him to help design and build the company's new automated operational systems.
Right.
And again, on the surface, this sounds like a massive compliment. You're hiring a brilliant chartered accountant. Why wouldn't you want their expertise in building your core systems?
Because it completely obliterates their objectivity. System automation and process reengineering are executive operational functions.
So translate this into a practical corporate reality for our CA final students.
Okay, imagine CAP actually agrees to this. He takes the lead on designing, coding, and implementing a brand new automated vendor payment system. He runs the agile sprints, he approves the logic gates, he formally signs off on the final software architecture.
That sounds like he's doing a great job.
Sure, but 6 months later, the annual audit plan requires an internal audit of the vendor payment process.
Oh no.
Exactly. He is now walking into a room to audit a system that he built himself.
And if the auditor builds the automated system, they have a massive, completely unavoidable vested interest in proving that it works perfectly.
Their objective outlook becomes completely obscured by the pride of creation. Think about it. If there is a critical logic flaw in the system that allows a duplicate payment to slip through, CAP is far less likely to find it.
Because he's looking at his own code.
Right, and he's even less likely to aggressively report it to the board because it is his personal flaw. You cannot be both the player on the field scoring the goals and the referee blowing the whistle for offsides. It just doesn't work.
You can advise on the rules of the game, but you can't step on the pitch and actually kick the ball.
Perfectly said.
And the text notes that CAP gave the company a very specific caveat. He stated he could not assume executive accountability for these operational areas. He can offer limited advisory input, like, for example, sitting in on a design meeting and saying, hey, whatever system architecture you choose, ensure it requires dual-factor authentication for payments over $50,000.
Yes, that's advisory.
But he cannot be the one actually writing the code or selecting the vendor or making the final operational decisions.
And maintaining that strict boundary is the absolute hallmark of a true professional internal auditor. The moment you make an operational decision, you own the risk of that decision. and an internal auditor can never audit a risk they own.
That's a great rule of thumb.
Now, what is encouraging in the text scenario is that Try and Scale Limited ultimately agreed to his terms.
Oh, really?
Yeah. This shows that a mature, responsible board actually wants that independent truth teller, even if executive management initially tries to suck them into operational tasks just because they are highly competent individuals.
Okay, so CAP has successfully defended his independence. He forced the company to route his reporting line directly to the audit committee, and he flatly refused to build the very IT systems he will eventually be tasked with auditing.
He's set up for success.
Right. So he's got his laptop, he's walking into the corporate headquarters on day one. What exactly is he looking for when he actually opens the company's books?
The text introduces us to SA 610. Let's make sure we define that clearly for the listener before we dive into mechanics.
Certainly. SA stands for Standard on Auditing. These are the mandatory, authoritative benchmarks and guidelines issued by the ICAI. They dictate precisely how audits must be conducted in India.
Okay.
SA 610 specifically deals with using the work of an internal auditor. But within its framework, it beautifully outlines the 6 core pillars that define the scope and objectives of the internal audit function. This is essentially the battle plan for what CAP will actually do on a daily basis.
Let's walk through these 6 pillars because this really transitions us from abstract governance theory into the granular reality of the job.
Let's do it. Pillar 1 is the monitoring of internal controls. Now, when I was first learning this, I always pictured internal controls like a bouncer at a very exclusive nightclub.
Okay, I like where this is going.
The company puts the bouncer at the door, hands them a list of rules, and says, check IDs, no one under 21, no exceptions. The internal auditor isn't the bouncer. The internal auditor is the person hiding in an unmarked car across the street with binoculars, checking if the bouncer is actually scrutinizing the IDs or if they're just waving their friends through the VIP line because they're tired.
That is a highly accurate way to visualize it. You are verifying the effectiveness of the control. You are not executing the control itself. And to ground this in a reality that a CA final student will actually face, the text provides a critical example: the three-way match.
Ah, the famous three-way match. Let's really deep dive into this because this isn't just about shuffling paper anymore. As our listeners probably know, when a three-way match breaks down in a modern multinational, millions of dollars can vanish into thin air.
It is arguably one of the absolute most fundamental internal controls in any business that procures physical goods. Historically, yes, it involved 3 physical pieces of paper.
Walk us through the paper version first.
Sure. Document 1, the purchase order. The procurement department issues a PO to a vendor for, let's say, 10,000 high-end laptops. That establishes what the company officially authorized.
Got it.
A week later, a logistics truck arrives at the company warehouse. The receiving clerk unloads the truck, counts the boxes, and generates a receipt of material often called a goods receipt note, or GRN.
Okay, document 2.
But let's say there was a supply chain hiccup, and only 8,000 laptops were actually on the truck. That GRN establishes what the company actually physically received.
Right.
Finally, the vendor's billing department sends an invoice to the company's finance department, naturally billing them for the full 10,000 laptops they initially ordered. That's document 3.
So, if the finance department is operating without any internal controls, they just look at the invoice for 10,000 laptops,
Yep.
They pull up the original purchase order that says 10,000 laptops, they see they match, and they blindly wire the money.
Exactly.
And they just paid for 2,000 laptops that never actually arrived in their warehouse.
Which is a massive loss. A proper internal control system dictates that a payment can only be triggered when all 3 data points are matched. The PO, which is what we authorized, the GRN, what physically entered our possession, and the invoice, what they are demanding we pay.
The triangle.
Right. And only the lowest common denominator should ever be approved for payment. In this specific scenario, the system must restrict the payment to 8,000 laptops.
But let's recalibrate this for our audience because a CA final student knows they aren't going to be sitting in a basement comparing physical carbon copies of these documents. In a modern corporation, this is all happening inside massive enterprise resource planning systems, right? Things like SAP or Oracle.
Right.
The bouncer isn't a person anymore. The bouncer is a line of code.
Precisely. And this is where the internal auditor's job becomes highly sophisticated. You are no longer just checking paper. You are auditing the IT general controls the ITGC. In a modern ERP system, the three-way match is totally automated through clearing accounts, which are often called GRI accounts.
So what is the auditor actually doing?
The internal auditor's job under Pillar 1 is to test the underlying logic and the security of that automation.
Give me an example of how that breaks down in the real world. How does a fraudster actually bypass an automated three-way match?
Tolerance limits are a prime example.
Tolerance limits.
Yeah. In any massive supply chain, there are constantly minor discrepancies. Freight charges change, slight price fluctuations happen. To maintain operational efficiency, management will program a tolerance limit into the ERP.
So they don't have to manually review every tiny difference.
Exactly. Let's say it's programmed at 2%. This means if the vendor invoice is up to 2% higher than the original purchase order, the system will just automatically approve the match and trigger the payment. Because honestly, it's not worth human intervention to argue over a $50 difference on a $100,000 order.
Okay, I see where this is going.
Right. So as an internal auditor, you don't just walk in and ask, is the three-way match turned on? You ask, what is the tolerance limit currently set at? And much more importantly, who has the super user administrative access to change that tolerance limit?
Oh, wow.
Because if a rogue procurement manager has the system access to suddenly change the tolerance limit from 2% to 15%, they can collude with the vendor, have the vendor consistently overbill by 14%, and the automated ERP system will just blindly approve every single fraudulent invoice without ever flagging it to finance.
That is brilliant and utterly terrifying. So the internal auditor is acting almost like an ethical hacker, probing the ERP's tolerance limits for logic vulnerabilities and access control failures.
That is Pillar 1 in a modern context. It's highly technical.
Let's move to Pillar 2, examination of financial and operating information. This feels a bit more like traditional auditing, right? Looking at the books to ensure the numbers are real.
It is, but it requires a deeply critical, investigative eye into the underlying operations that actually generate those numbers. The auditor looks at sales records, delivery dispatch logs, and sales commission payouts to identify the absolute economic reality of the revenue being recorded.
What are they looking for specifically?
They are hunting for things like artificial inflation of revenue, often called channel stuffing.
Channel stuffing. That's when the sales team is desperate to hit their quarterly targets to trigger their massive bonuses, right?
Exactly. Imagine it's the last week of Q3. The sales director is, say, $5 million short of their target.
Panic time.
Total panic. So they call up their primary distributors and say, listen, I am shipping you $5 million worth of excess inventory today. I know you didn't order it, but just accept the delivery, sign for it, and I promise you can return it all on the first week of Q4 with zero penalty.
So on paper, the company records a massive $5 million sale in Q3. The revenue looks fantastic, the executives all get their bonuses, but the actual economic reality is a total fiction.
Total fiction. And the external financial statements won't immediately catch that if they just look at the sales invoices generated on that day.
Right, because an invoice exists.
Exactly. The internal auditor under Pillar 2 has to dig into the operating data. They look at the subsequent month's sales returns. They look at the freight logs. They go out and interview the warehouse managers. They ensure the financial numbers being reported to the bridge actually reflect genuine economic activity, not just financial engineering.
Which perfectly bridges us into Pillar 3, review of operating activities. Because you can't uncover channel stuffing just by staring at a spreadsheet. You have to look at the physical movement of goods. The text uses the example of inventory management, specifically the custodianship and safeguarding of assets.
This is where the internal auditor gets out of the office and into the physical reality of the business. It is simply not enough for the CFO's balance sheet to proudly proclaim, we hold 50 million rupees in inventory.
The internal auditor has to ask, where is it?
Where is it? And in what condition is it? Are those highly sensitive, extremely expensive electronic components sitting out in a humid, leaky warehouse slowly corroding into worthlessness?
Or is the warehouse physically secure? I remember reading a case where a company had millions in inventory on the books, but their warehouse literally had no suctional locks on the loading dock doors. Anyone could just walk in off the street and carry out a box of microchips.
Exactly. The internal auditor reviews the physical handling, the security protocols, and the environmental controls to prevent damage, theft, and loss of value.
How does that look today?
Today, this might involve auditing how the company uses RFID tagging or even drone-based inventory counts to maintain physical control over massive, sprawling logistics hubs. It's very hands-on.
Okay, so we have controls, information, and operations. Pillar 4 brings us to something that is increasingly keeping CEOs awake at night: review of compliance.
Oh,
The
absolutely.
regulatory landscape is just a total minefield right now. You have new tax codes, new labor laws, massive new data privacy acts like GDPR or the DPDP Act in India.
The landscape is not only complex, it is constantly shifting beneath their feet. Let's take a publicly listed company operating in India as an example.
Okay.
They fall under the strict jurisdiction of SEBI, the Securities and Exchange Board of India. SEBI has incredibly rigorous rules regarding insider trading, continuous disclosure requirements, and related party transactions.
Right.
The internal auditor must rigorously test whether the company's internal machinery is actually keeping them on the right side of the law.
But this brings up another fascinating trap highlighted in the text: the scenario of CA Diva. This is a brilliant test question example for our listeners. Let's walk through it.
Yes, the CA Diva trap is essential reading.
So CA Diva is hired as the internal auditor for a listed company. The executive management approaches him and says, "Diva, you are the absolute expert on SEBI regulations. We are terrified of accidentally violating these laws and getting fined. We want you, the internal auditor, to personally manage our compliance tracking system. We want you to be the one directly corresponding with the regulator and filing the forms on our behalf."
It's so sneaky.
Right. Because again, to a stressed CEO, this sounds like a highly efficient use of an expert's time. Why is this a trap?
It sounds incredibly efficient until you remember the golden rule we established with CAP independence. The scope agreed upon by the audit committee was compliance with laws and regulations, which means auditing the compliance mechanisms.
The executive management is trying to trick CA Diva into executing the compliance.
Exactly. They are trying to turn the scout into the engine room mechanic. Let's play out the consequences of this.
Okay.
If CA Deva agrees to actually manage the compliance tracking system, he assumes operational responsibility. 6 months later, he is incredibly busy, and he accidentally forgets to file a critical quarterly disclosure form with SEBI before the deadline.
Oh boy.
A month later, it's time for his internal audit of the compliance function. What happens?
He has to audit his own failure. He's literally staring at the missed deadline that he caused. And he is certainly not going to write a report to the audit committee saying, "The company failed its compliance requirements this quarter because I, the internal auditor, forgot to send an email."
Precisely. He would be auditing his own executive actions, and his objectivity is instantly destroyed. The professional standard demands that you must audit the compliance framework. You cannot manage the compliance framework.
You evaluate if the compliance officer is doing their job. You do not become the compliance officer.
Exactly. The player and the referee paradigm strikes again. It is truly amazing how consistently management will try to blur that line.
All right, let's move to Pillar 5, risk management. The text specifically mentions evaluating exposure to complex financial instruments.
Right?
So if the company's treasury department is using exotic derivatives to hedge currency risk because they import raw materials from Europe, the auditor needs to make sure they aren't accidentally gambling the company's entire cash reserve on foreign exchange fluctuations.
Yes, that's a huge part of it. They evaluate if the actual risk exposure out in the market aligns with the board of directors' stated risk appetite.
What do you mean by risk appetite?
Well, if the board explicitly says, we are a conservative manufacturing company, we only use derivatives for basic hedging, but the internal auditor finds out the Treasury Department is engaging in highly leveraged speculative options trading just to artificially boost their departmental profits.
That's a huge problem.
That is a massive existential risk that the bridge needs to know about immediately. The scout has to flag that.
Which feeds directly into the final and perhaps most abstract pillar, Pillar 6, governance. How do you actually audit something as intangible as governance?
It's challenging. You audit the tone at the top, and you audit the actual mechanisms of ethics. The internal auditor assesses if the company is actually accomplishing its stated objectives regarding ethics and corporate values.
It's not enough to just have a beautifully designed code of conduct poster in the break room.
Right. It's about what happens when things actually go wrong. For example, auditing the whistleblower policy.
Oh, that's a great example.
Does the company have an anonymous whistleblower hotline? Is it actually functional? When an employee calls that hotline to report that their manager is taking kickbacks from a vendor, what actually happens to that data?
Right, does it go anywhere?
Is it independently investigated by a dedicated committee, or does the complaint just get routed right back to the corrupt manager's department head and quietly buried? Auditing governance means verifying that the ethical infrastructure of the company is fully operational, not just decorative.
Okay, so we have laid out these 6 massive pillars of scope: monitoring controls, examining information, reviewing operations, reviewing compliance, risk management, and governance.
A massive scope.
It is. But looking at this extensive list, I have to ask the question that literally every finance executive asks when they look at their audit budget.
Let me guess. Why are we paying twice?
Exactly. If the internal auditor is examining financial information, deeply testing internal controls, and evaluating risk, isn't that exactly what the external statutory auditor does at the end of the financial year? Are companies just paying 2 different sets of highly expensive professionals to do the exact same job?
It is a very common and honestly very fair question. And it is entirely true that there is a significant overlap in the specific areas they examine. Both the internal auditor and the statutory external auditor care deeply about internal controls and the reliability of financial data.
So what's the difference?
Their relationship to the company, their primary allegiance, and their ultimate objective are entirely different. Think of the external auditor as a highly specialized medical examiner performing an annual autopsy,
An autopsy.
or at best, an annual physical exam for a life insurance policy. They come in once a year, they look at the historical data, they sample the transactions, and their sole objective is to give an independent opinion to the shareholders, the public, and the regulators on whether the final financial statements present a true and fair view.
They are looking backward at what already happened.
Exactly. And the internal auditor. The internal auditor is the central nervous system of the living patient.
Oh, well, that guy.
They are an integral, continuous, 247 part of the company's internal control environment itself. They aren't just looking at whether the numbers are right at year end. They are actively trying to pull the company's hand off the hot stove before the tissue damage is permanent.
They are serving management and the board to actively improve and protect the company from within.
Precisely. And SA 610 actually formalizes how these two interact, doesn't it? The external auditor doesn't just ignore the internal auditor's work.
They work together.
Exactly the opposite of ignoring them. The external auditor actually relies heavily on the internal auditor.
Oh, really?
Yes. If the external statutory auditor walks into a company at year end and sees that a highly competent, truly independent internal audit team has been rigorously testing the SAP tolerance limits, running drone inventory counts, and validating the three-way match all year long.
They don't have to do it all over again.
Exactly. The external auditor can place reliance on that internal work. It significantly reduces the nature, timing, and extent of the external auditor's own substantive testing. They work in tandem. The internal auditor optimizes the machine from the inside. The external auditor verifies the machine's output for the outside world.
That is a phenomenal distinction. The autopsy versus the central nervous system. I want every CA final student to write that down.
It really clarifies the roles.
This actually transitions us perfectly into understanding how the internal auditor integrates with the broader corporate machinery. We've talked about these micro-level tasks, checking tolerance limits in SAP, looking at warehouse roofs, testing whistleblower hotlines, but how does this all fit into the macro vision of the C-suite?
To understand that connection, we really need to briefly step back and define what management actually is in a formal corporate context.
Okay, lay it on us.
The text provides a rigorous definition. Management is the process of conducting the affairs of an enterprise in such a manner that its goals and objectives are attained through the optimum utilization of all available resources within legal, social, economic, and environmental constraints.
That is a dense, very academic mouthful.
It is.
But essentially means using what you have, like capital, people, technology, to get what you want, which is profit or market share, without breaking the law or ruining the environment.
That's the perfect translation.
And classical management theory breaks this massive undertaking down into 5 core functions: planning, organizing, staffing, directing, and controlling.
Yes. And understanding the fundamental distinction between the first 4 functions and the 5th function is the absolute key to understanding the internal auditor's true value proposition to the board.
Right. I actually love the analogy for this. Think of building a business like planting a massive commercial vineyard from scratch.
Okay, let's hear the vineyard analogy.
So the first 4 functions are inherently optimistic. They are all about creation and growth. Planning is the visionary phase. It's deciding what kind of grapes to grow, forecasting market demand, and mapping out the fields.
Right.
Organizing is the logistical phase. It's buying the tractors, setting up the complex irrigation lines, and building the trellises. Staffing is the human element. It's hiring the expert viticulturists, the soil chemists, and the harvest crew.
Making sure you have the right people.
Exactly. And directing is the execution phase. It's the manager out in the field every morning telling the crew, water the north sector today, prune the south vines tomorrow.
So those four are all about output.
Yes. Those four functions, planning, organizing, staffing, directing, they create the product. They grow the grapes. They generate the stakeholders' wealth. But the fifth function, controlling, is entirely different.
How so?
Controlling does not grow a single grape. Controlling is building the 12-foot electrified fence around the perimeter of the vineyard. Controlling is installing the security cameras. Controlling is testing the soil pH every week to make sure a devastating fungus isn't quietly spreading through the roots.
I see.
Controlling doesn't create wealth, it preserves the wealth you've created.
That is a brilliant way to frame it. The first four functions are about building the engine, but without the controlling function, all that generated wealth can be instantly lost to internal fraud, catastrophic operational inefficiency, or massive regulatory fines.
And that's where internal audit fits in.
Internal audit is the absolute sharpest, most sophisticated tool in management's controlling toolbox. It operates independently of the daily operations, but it is utterly essential for management to actually retain the value they worked so hard to build.
So when the internal auditor is out there inspecting the fence, to keep with the vineyard analogy, how do they actually execute this controlling function? It's not just running back to the CEO and tattling, right? Like, hey, boss, there's a hole in the south fence.
No. It goes much, much deeper than just identifying gaps or playing the corporate police.
What's the deeper level?
Well, a junior, inexperienced auditor might just point out a symptom. During our sample testing, we found 10 duplicate payments made to vendor X.
Okay, symptom identified.
But a true professional internal auditor, acting as a critical component of the management controlling function, must perform root cause analysis. They must ask the 5 whys.
The 5 whys.
Yeah. Why did the system allow duplicate payments? Is it a software glitch in the new ERP update? Is the accounts payable cloak untrained on the new interface? Or is someone intentionally bypassing the three-way match by splitting invoices below the approval threshold?
You have to find the disease, not just the symptom.
Exactly. Once the true root cause is identified, the auditor must recommend specific, actionable mitigating steps to strengthen the internal control environment so that the root cause is completely eliminated and the hole in the fence is permanently sealed.
It's the difference between merely treating a symptom with a painkiller and surgically curing the underlying disease.
Precisely.
But practically speaking, how wide does the scope go? A modern multinational has thousands of processes. Does the internal auditor look at literally every single process in every single department every single year? That seems mathematically impossible.
It is entirely impossible, and attempting to do so would be a massive waste of resources. That is why the scope of the internal audit plan is highly dynamic. It's dependent on a few critical factors.
Like what?
First, obviously, the size and structural complexity of the organization.
Sure.
Second, and most importantly, the risk appetite of the organization.
How does risk appetite change the audit?
Think about it. Some highly aggressive tech startups are completely willing to accept significant operational risk in exchange for rapid growth. So their audit scope will reflect a focus on existential risks rather than minor inefficiencies.
They don't care about a $50 discrepancy.
Exactly. A highly regulated bank, however, has a zero-tolerance risk appetite for compliance failures, and their audit scope will be exhaustive in that area.
Makes sense.
Third, they evaluate the specific risk underlying individual business processes. A highly automated, mature payroll system that hasn't changed in 5 years might be audited far less frequently than a brand new, manual, high-value procurement process in a newly acquired subsidiary in an emerging market.
You look where the danger is.
Right. And finally, they consider the effort involved versus the value provided. They must strategically prioritize their coverage to ensure all highly auditable, high-risk areas, the places where the dragons most likely live, are addressed within the annual audit cycle.
So it's a strategic, risk-based deployment of limited resources.
Right.
You send your scouts to the most dangerous parts of the map first.
Exactly right.
Okay, this is all fantastic governance theory. We know it's an incredible tool. We know how it preserves stakeholder wealth. We know how they maintain their independence. But let's bring this out of the theoretical realm and into the hard reality of the law.
The legal mandates.
Is having this internal audit function optional? Like, can a CEO just decide, you know what, we trust our people, we don't need a scout, let's save the money? For a massive segment of the corporate world, the law says absolutely not right.
Exactly. This brings us to Section 138 of the Companies Act, 2013, specifically read with Rule 13 of the Companies Accounts Rules, 2014.
Okay, let's break this down.
Now, for anyone studying this for an exam, it is incredibly easy to get bogged down in rote memorization of the numerical thresholds. But if you want to truly master the subject, you need to understand the macroeconomics behind the law.
What's the bigger picture?
You need to frame these numbers as thresholds of systemic corporate responsibility. The government is essentially drawing a line in the sand and saying, once your company reaches a certain scale of economic impact, having a scout on the ship is no longer just good business practice, it is a mandatory legal requirement for the safety of society at large.
Let's translate those specific numbers into what they actually represent in the real world. First category, every listed company, period.
Yes.
If your stock is traded on the open market, like the Bombay Stock Exchange, the National Stock Exchange, and everyday retail investors can log onto an app and buy a piece of your company with their retirement savings, you must have an internal auditor.
Correct. The moment you invite public money into your equity structure, the public demands independent oversight. You surrender the right to operate in the dark.
But the law doesn't stop at listed companies. It moves to unlisted public companies.
Right. Even if your shares aren't traded on a stock exchange, if you hit certain size thresholds, society still demands oversight because your potential failure would cause a massive economic crater.
Let's look at those thresholds. For example, the law mandates an internal auditor for an unlisted public company if they have a paid-up share capital of 50 crore rupees or more during the preceding financial year.
50 crores.
Let's pause and really think about that. 50 crore rupees in paid-up capital, that's roughly $6 million of pure equity locked into the company.
It's substantial.
Think about what a company of that size actually represents. That isn't a mom-and-pop corner store. That is an enterprise that employs hundreds, maybe thousands of people. It anchors a local economy. It likely has a massive supply chain of smaller, dependent vendors.
Absolutely.
If a company of that size collapses because the CEO was quietly siphoning funds and bypassing internal controls, the blast radius is devastating. It doesn't just hurt the wealthy founders, it bankrupts the small vendors who haven't been paid, it puts thousands of working-class people out of work, and it shocks the entire regional economy.
Precisely. The government mandates the internal auditor to actively prevent that localized economic disaster.
And the exact same logic applies to the turnover threshold, doesn't it?
It does. If an unlisted public company has a turnover, meaning gross sales or revenue of 200 crore rupees or more, they are legally required to appoint an internal auditor.
200 crores in revenue means you are moving massive amounts of capital through the system. You are a systemically important player in your sector.
Yes, you're too big to fail quietly.
And then there's the debt component, which I find fascinating because it brings the banking system into play. The law states that if you have outstanding loans or borrowings from banks and public financial institutions exceeding 100 crore rupees at any point in time during the preceding financial year, you must have an internal auditor.
Because at that point, you're no longer just playing with your own money. You're playing with the bank's money.
Right.
And where does the bank get its money? From the everyday depositors. You're playing with the public savings. If you default on a 100 crore loan because of internal fraud or catastrophic operational failure, you severely weaken the bank.
And if enough large companies do that?
If you trigger a full-blown banking crisis, the lenders, and by extension the government regulators, demand that an independent scout is continuously checking the books to ensure you aren't gambling away a 100 crore loan on unsecured, unhedged risks.
It's essentially a systemic risk insurance policy mandated by the state.
That's a great way to put it.
And just for completeness, there are also thresholds for private companies, turnover of 200 crores or more, or outstanding loans exceeding 100 crores. The logic remains the exact same.
Right.
Once you're big enough to hurt the economy, you must be watched.
Exactly.
So let's say a company hits one of these thresholds. They cross 100 crores in bank debt. Who actually gets this mandated job? Who's legally qualified to be this scout?
The law is quite specific yet slightly flexible. Section 138 specifies that the internal auditor shall either be a chartered accountant or a cost accountant.
Okay.
And interestingly, the Act explicitly clarifies that they do not necessarily have to be a professional engaged in independent public practice. They can actually be a full-time employee of the company.
Oh, which brings us right back to the CAP scenario. You can be an employee drawing a salary from the company, but you must maintain that structural independence by reporting to the audit committee.
Exactly. The framework relies on the profound professional ethics of the chartered accountant, combined with the structural protection of the audit committee to maintain objectivity, even in an employer-employee relationship.
Are CAs the only ones who can do it?
Well, the law also allows for such other professional as may be decided by the board. This gives some necessary flexibility for highly specialized industries. For example, maybe you need to hire an engineer to audit complex metallurgical processes, but the core responsibility usually falls to the CA.
Right.
The key legal requirement is that the board of directors, usually acting through the audit committee, actually formulates the scope, the functioning, the periodicity, and the methodology of the audit.
All right, so let's put it all together. You are a CA finalist.
Yeah.
You pass your exams. You get hired as the chief internal auditor for a massive unlisted public company that just crossed the 200 crore turnover threshold.
Congratulations.
You've negotiated your independence. You are reporting directly to the audit committee. It's day one. You walk into the corporate headquarters. How do you actually hit the ground running? What is step one of the audit process? Because I imagine if you just open the master financial spreadsheet and start randomly looking for anomalous journal entries, you are going to drown in data.
If you start by blindly staring at a spreadsheet, you have already failed. You will be completely, hopelessly lost in the fog of war we talked about earlier.
So what is step one?
Step one of the audit process is to deeply obtain knowledge of the business and its environment. And you do not get that from a spreadsheet. You start with conversations.
Conversations with who?
The auditor must conduct extensive meetings with key stakeholders, the board of directors, and key management personnel.
Why is that human element so critical before looking at the numbers?
Because you cannot effectively audit a process if you do not fundamentally understand the purpose of the process. You need to understand the organization's overarching vision, its mission, and what the top management actually expects from the audit function.
Are they scared of something specific?
Exactly. Are they primarily terrified of regulatory compliance failures, or are they bleeding cash due to operational inefficiencies in their logistics network? Furthermore, you have to understand the corporate culture.
How does culture affect the audit?
Well, if the tone at the top is aggressively focused purely on hitting quarterly revenue targets at any cost, the spreadsheets will be perfectly flawlessly faked to hide channel stuffing. You need to read the room. You need to deeply understand the pressures management is under.
That makes total sense. You have to understand the psychology of the engine room before you even look at the gauges.
Yes. And then after the conversations, they review the documents, the standard operating procedures, the organizational charts, the historical financial statements.
But there is a massive technological component to step one now, isn't there? You mentioned the IT infrastructure earlier.
It is arguably the most critical part of step one in a modern corporate audit. The auditor is mandated to obtain a comprehensive understanding of the underlying information technology landscape. We are talking about mapping out the various localized applications and the overarching ERP systems.
Let's make sure everyone understands how deep this goes. An ERP, an enterprise resource planning system like SAP or Oracle, isn't just a digital ledger where accountants type in numbers. It is the central nervous system of the entire corporation.
It connects everything.
Right. If a salesperson in Bangalore closes a deal on their company iPad, that data flows through a digital pipe, instantly updates the physical inventory allocation in a warehouse in Pune, triggers an automated purchase order to a raw material supplier in Vietnam, and instantaneously alters the consolidated balance sheet viewed by the CFO on a dashboard in Delhi.
Exactly. And an internal auditor today must be completely fluent in how that data moves through those specific digital pipes. Because if you don't understand the architecture of the ERP, you simply do not understand how the company functions.
You're flying blind.
You cannot audit the three-way match if you don't know which specific module in SAP executes it, how the tolerance keys are configured, and who holds the super user access rights to override the system.
Right.
You also have to deeply understand the management information systems, the executive dashboards that the CEO relies on to make strategic decisions. Because if the underlying data architecture is flawed, or if the data extraction logic is corrupted, the dashboard is literally lying to the CEO, and the bridge is flying blind.
You essentially have to be an ethical hacker and a systems architect before you can even begin to be an accountant.
Pretty much.
You have to map out where all the digital pipes connect, where the valves are, and who has the keys to the valves before you can find the leak. And they also have to map out that complex regulatory landscape we discussed earlier, understanding exactly which SEBI rules or environmental laws apply to their specific industry.
Right.
All of this is just step one, just getting the lay of the land.
Yes. It is exhaustive work. And once they deeply understand the business, the IT architecture, and the regulatory constraints, they move to step two: perform audit planning.
Okay, what drives step two?
This phase is heavily governed by SIA 310.
Another crucial acronym for our listeners to note down. SIA stands for Standard on Internal Audit, issued by the ICAI.
Correct. SIA 310 dictates precisely how to plan the actual audit assignment. It involves conducting a comprehensive risk assessment, allocating resources, and defining the precise scope of the review.
Okay.
But crucially, the final audit plan, the battle plan of exactly which departments they're going to look at, how deep they will go into the ERP systems, and what resources they need, must be formally reviewed and approved by the audit committee and the board of directors.
Wait, why does the board have to approve the plan? Why can't the auditor just decide what to look at?
Because this formal approval ensures the auditor has the full, explicit mandate and backing of the highest governance body in the company before they start walking around the organization, demanding access to highly sensitive IT systems and asking incredibly uncomfortable questions of powerful executives.
Right. They need that armor we talked about. They need to be able to walk into the engine room, flash their mandate, and say, I'm not here because the CFO sent me, the captain sent me, open the books.
Exactly. It gives them the authority to do their job.
Well, to bring this all together for you, the listener, as you prep for your CA final exams or tackle the brutal realities of real-world corporate governance, we started by navigating the incredibly chaotic, high-stakes landscape of modern multinational business.
A very chaotic landscape.
We established that because the C-suite cannot see everything, they are terrified of their own blind spots and they desperately need a scout. We proved the absolute, non-negotiable necessity of that scout's independence, why CAP had to demand reporting to the audit committee and not the CFO.
And why an auditor can never design or build the operational systems they will eventually audit.
Exactly. We explored the 6 massive pillars of their scope under SA 610, moving from the sophisticated IT general controls of an automated three-way match, to outsmarting channel stuffing, to navigating the treacherous regulatory landscape without falling into the trap of managing compliance like CA Deva.
The player and referee paradigm.
Right. We saw how internal audit acts as the ultimate wealth preserver within classical management's controlling function, the fence around the vineyard. We explored why this function is legally mandated under Section 138 of the Companies Act for companies whose size poses a systemic risk to the economy.
Because society demands it.
And finally, we saw how an auditor starts their monumental task, not with a spreadsheet, but by deeply understanding the business, its culture, and its complex digital heartbeat.
It is a massive, incredibly complex, and vital responsibility. The internal auditor is the ultimate guardian of reality for the organization. Without them, corporate governance is merely an illusion.
It is. But I want to leave you with a final provocative thought to mull over as you close your textbooks tonight. Something that builds on everything we've just discussed about ERP systems, automation, and the absolute necessity of human independence.
Well, this is a good one.
The entire premise of the internal audit profession, as we've defined it today, relies heavily on human objectivity and human insight. It relies on a human chartered accountant being brave enough to look a powerful CFO in the eye and tell them they are wrong.
Yes.
But look at the trajectory of technology. As artificial intelligence becomes exponentially more powerful, what happens when an AI system is capable of continuously monitoring 100% of a company's millions of transactions in real time?
It's coming.
What happens when an AI can instantly flag a broken three-way match,
Right.
detect a subtle pattern of channel stuffing across global subsidiaries, or identify a regulatory compliance breach the exact microsecond it happens?
It changes everything.
And crucially, an AI has no office politics. It has no bias. It doesn't care about annual performance reviews, it doesn't need a salary, and it certainly doesn't fear being fired by the CFO.
That's true independence.
Right. So in the very near future, as you step out of your exams and into this profession, will the chartered accountant's job still be auditing the business? Or will your job elevate to auditing the AI that audits the business? Who checks the logic of the machine? Think about that as you prepare. The ship is changing faster than ever, and the scout is going to have to evolve.